Have you heard of the company Shein?
Taylor Shein is in hot water once again.
Shein has faced accusations of worker abuse.
The brand has recently come under fire.
It's the latest brand to take the fast fashion world by storm.
They don't call themselves fast fashion. They like the on-demand fashion.
Have you ever wondered why the world's most addictive shopping app is struggling to go public?
Welcome to the world of Shein. It was reported the fashion startup was worth $100 billion.
A company that sells $5 dresses to 150 countries, makes $38 billion in revenue, but can't seem to find a stock exchange willing to embrace it. This is the fascinating story of Shein, and today we're going to decode one of the most controversial IPO sagas of our time. But here's the million-dollar question. Can a business built on disposable fashion survive in a world racing towards sustainability? Stay with me because this case study will teach you everything about modern business challenges, regulatory politics, and the clash between growth and responsibility. Most Americans couldn't even pronounce Shein in 2015.
Shein.
I say Shein.
By 2023, the brand quietly grabbed a massive chunk of US fast fashion, beating labels that spent decades building stores. How? Dirt cheap clothes, relentless trend drops, and an app that feels more like TikTok than a mall. During lockdowns, when traditional retailers were drowning in unsold jackets, Shein's sales multiplied sixfold. Every swipe was a survey. Every abandoned cart whispered what to make next. This wasn't luck. It was a systems play. While competitors fought for shelf space, Shein built a data refinery. The goal wasn't to predict trends. It was to sense them in real time. That meant starting with a radical choice. Make less, not more, until the data says, scale it. Great, small batches, quick reactions. But can software really fix fashion's oldest problem? Let's start by understanding what makes Shein tick. Think of Shein as the Netflix of fashion, but instead of recommending movies, they're using AI to predict what you'll want to wear tomorrow.
So you have this very addictive algorithm, influencers, and young women.
Here's their genius business model. Shein's algorithms continuously scan social media platforms like TikTok and Instagram, identifying micro-trends before they even become mainstream. Once they spot a potential hit, let's say neon green crop tops are trending, they don't order 10,000 pieces like traditional retailers. Instead, they order just 100-200 pieces from their network of 5,800 small Chinese workshops. But here's where it gets interesting. If those 100 pieces sell out in 24 hours, they immediately restock. If they don't, they move on to the next trend. This approach keeps inventory risk incredibly low while maximizing profit margins. The result? Shein uploads 10,000 new products daily and achieves $38 billion in sales in 2024. But as we'll see, this success formula is exactly what's making their IPO journey so complicated. Initially, Shein had their eyes set on the biggest prize, a New York Stock Exchange listing.
Shein, the major online retailer,
has filed confidentially to go public in the United States.
This was first reported by the Wall Street Journal. It could be one of the biggest IPOs in years. They've totally changed the model and have captivated American consumers.
After all, the US is their largest market, and American investors love high-growth tech companies. But here's what went wrong. US regulators started asking uncomfortable questions about forced labor, particularly regarding cotton sourcing from Xinjiang. The Biden administration was also tightening disclosure requirements for Chinese companies, making Shein's path to NYSE increasingly difficult.
China's internet police now reviewing how Shein handles data.
It's facing a security review in China, adding that the review centers on its supply chain presence.
The lesson here is crucial. In today's world, where you list your company is as important as how much you're worth. Geographic politics can make or break even the most successful businesses. After the US setback, Shein pivoted to London.
Change of its IPO venue from the US to the UK, Shein is stepping up preparations for a London listing.
And honestly, it seemed like a match made in heaven. Here's why. The UK government was desperately trying to revive London's IPO market, which had been losing ground to New York and even some Asian exchanges. They were actively courting high-growth companies with relaxed listing requirements. The British pitch was simple. Come to London, we'll make it easier for you to list, and you'll help us regain our status as a global financial hub. By April 2025, Shein received conditional approval from the UK's Financial Conduct Authority. a major victory that suggested London could still attract global megacaps. But then reality hit hard. Remember how Shein was valued at $66 billion in their 2023 private funding round? Well, public market investors had other ideas. Here's what happened. Investors looked at Shein's financials and saw some concerning trends. Net profit had slid 40% to about $1 billion despite sales growth. New US import tariffs were eating into margins. Only 10% of shares were being offered to the public, meaning new investors would have minimal control. Reuters reported that the valuation target kept dropping, from $66 billion to $50 billion, then down to $30 billion. That's a 55% haircut from their private market valuation. Here is a business lesson. Private market valuations and public market realities are two completely different games. Public investors scrutinize everything: financials, governance, sustainability, and long-term viability. But here's where Shein's story takes an unexpected turn. Even as London seemed ready to welcome them, Beijing had other plans. Since most of Shein's suppliers are in China, they needed approval from the China Securities Regulatory Commission for any offshore listing. But sources revealed that the CSRC objected to specific wording in Shein's London prospectus, particularly descriptions of Xinjiang cotton risks. This created a fascinating geopolitical dilemma. Shein needed to satisfy Western regulators' transparency demands while not offending Chinese authorities. It's like trying to serve two masters with completely opposite requirements. The situation became even more complex when Washington scrapped the de minimis duty-free loophole.
I always say tariffs is the most beautiful word to me in the dictionary. Tariff.
Slapping 30% tariffs on direct from China parcels under $800. A devastating blow to Shein's core business model. By July 2025, Shein had quietly filed a draft prospectus with the Hong Kong exchange.
Shein and the potential for it to come to Hong Kong.
This wasn't just Plan B, it was a strategic chess move. Think about it. Hong Kong offers several advantages: closer cultural alignment with Chinese authorities, potentially easier regulatory approval process, growing focus on attracting tech companies, strategic location between East and West. But Hong Kong isn't exactly a regulatory haven either. The exchange has ramped up sustainability reporting requirements, and Shein would still need mainland China's blessing. Some analysts believe Shein is playing a dual-track strategy, using Hong Kong momentum to pressure London into softening disclosure demands while keeping options open.
Shein filed for a listing in London. It was about 18 months ago, and then now reportedly in Hong Kong as well. Do you think that this move would pressure London to say, oh, look, you're going to miss out on this?
Now, let's talk about the elephant in the room: environmental, social, and governance (ESG) concerns. This is where Shein's growth at all costs model collides with modern business realities. Shein's own sustainability report shows greenhouse gas emissions jumped 23% to 26.2 million tons in 2024.
Faced challenges, including accusations that it used forced labor in its supply chain, that it violated labor laws and stole designs from independent artists.
To put this in perspective, if Shein were a country, its emissions would rival Lebanon's. The math is brutal. While Shein talks about water-saving technologies and recycling initiatives, they're uploading 10,000 new products daily. It's like trying to empty a swimming pool with a teaspoon, while someone else is filling it with a fire hose. Labor activists have raised red flags about working conditions across Shein's 5,800 supplier factories. In January 2025, UK parliamentary committee members grilled Shein's legal counsel about Xinjiang cotton sourcing, with MPs accusing the company of willful ignorance.
The Fashion Transparency Index, which rates companies on how open they are about their supply chains, listed Shein at the bottom of its rankings.
Even Shein admits their auditors found 2 cases of under-16 labor in 2023, though they suspended and remediated those suppliers. Here's a critical point. Shein was planning to offer less than 10% of equity to public investors. This means new shareholders would have virtually no say in board composition or sustainability roadmaps. For responsible investment funds managing over $2 trillion globally, this kind of governance structure is a non-starter. The regulatory environment is becoming increasingly hostile to fast fashion. Here's what Shein is facing: European crackdown. In May 2025, the European Commission and 4 member states formally warned Shein about fake discounts, dark patterns, and misleading sustainability claims.
Plenty of people have taken to social media to protest the shoddy quality of its clothes.
Honestly, I thought just the swimsuits were gonna be trash. I could not be more disappointed. This is a piece of crap.
The company has 1 month to propose remedies or face fines. French innovation. France is pioneering a fast fashion penalty bill that would impose escalating fees on ultra-low-cost clothes to fund recycling programs. If this model spreads, Shein's unit economics could completely unravel. US policy shift. The elimination of the de minimis exemption means Shein's US customers now face 30% tariffs on their orders. This destroys one of Shein's core competitive advantages, ultra-low prices. Sensing the changing winds, some analysts suggest Shein might pivot to an Amazon-like marketplace model. Instead of holding inventory and managing supply chains directly, they could take commissions while third-party vendors shoulder ESG liability. This could be genius because it reduces direct environmental responsibility, shifts labor compliance to individual vendors, maintains the technology platform advantage, reduces capital requirements, but it also means giving up control over the core business that made Shein successful in the first place. Here's where this story gets really interesting. Despite all the regulatory pressure and ESG concerns, Shein's core customers, primarily Gen Z consumers, continue shopping. The contradiction is fascinating. Young consumers are the most environmentally conscious generation in history, yet they're also driving the haul culture trend on TikTok. They demand sustainability from brands while simultaneously seeking ultra-low prices. This generational divide might be Shein's biggest long-term challenge. As these consumers mature and gain purchasing power, will their values align with their shopping habits? Based on our analysis, Shein's IPO saga could end in 3 ways. Scenario 1, the London listing. Shein successfully addresses ESG concerns, gains Chinese approval, and lists in London at a reduced valuation. This requires significant operational changes and transparency improvements. Scenario 2, the Hong Kong compromise. Shein lists in Hong Kong with Chinese government support, potentially followed by a dual listing in London later. This path offers more regulatory predictability, but might limit Western institutional investor participation. Scenario 3, the private path. Facing insurmountable regulatory hurdles, Shein remains private, potentially exploring domestic Chinese listings or continued private funding rounds. This Shein saga teaches us several crucial lessons about modern business. Lesson 1. Growth without governance is unsustainable. Shein's reluctance to offer meaningful equity stakes to public investors reflects an outdated mindset. In today's market, investors demand both returns and representation. Lesson 2. Regulatory arbitrage has limits. Shopping around for the most favorable regulatory environment works only until regulators start talking to each other. Global coordination on sustainability and labor standards is increasing. Lesson 3. Technology alone can't solve systemic issues. Shein's AI-driven model is impressive, but it can't overcome fundamental sustainability challenges inherent in fast fashion. Lesson 4. Stakeholder capitalism is real. Modern businesses must balance shareholder returns with environmental responsibility, labor rights, and social impact. Ignoring any stakeholder group creates long-term risk. Shein's IPO struggles signal a broader transformation in the fashion industry. Traditional fast fashion is facing an existential crisis as consumers become more environmentally conscious. Regulators impose stricter sustainability requirements. Investors demand ESG compliance. Technology enables more sustainable alternatives. The companies that will thrive are those that can innovate their way out of the sustainability versus profitability dilemma. So, can Shein successfully go public? The answer depends on their willingness to fundamentally transform their business model. If Shein can implement genuine sustainability initiatives, improve labor standards across their supply chain, offer meaningful governance rights to public investors, navigate the geopolitical complexities between China and the West, then yes, they have a path to a successful IPO. But if they continue with business as usual, they'll likely remain trapped in regulatory limbo, unable to access public capital markets despite their impressive growth metrics. Here's my question for you. As consumers, do we bear responsibility for the environmental and social impact of our purchasing decisions? And as future business leaders, how would you balance growth ambitions with sustainability imperatives? The Shein story isn't just about one company's IPO struggles. It's a preview of the challenges every business will face in the stakeholder capitalism era. What do you think? Should Shein be allowed to go public as they are, or should they be forced to change their model first? Let me know in the comments below. If this deep dive into the intersection of business, politics, and sustainability was valuable to you, hit that like button, share it with someone who needs to understand these emerging business realities, and subscribe for more case studies that decode the complexities of our changing world. Until then, stay curious, This is Jump to Future, and I'll see you again soon.